Advanced audit and assurance. We have covered the two areas of our syllabus: audit report and ethical and other professional issues. Now we are moving towards the main area of our syllabus, that is audit planning and risk. Audit planning and risk. We need to discuss different accounting standards. We need to discuss different auditing standards. And then we need to practice so many 50 marks case study questions. So let's start with audit planning. So towards audit plan. This is auditing standard ISA 300. And according to ISA 300, audit planning, an auditor must plan his work before starting. Before starting the audit work, there must be audit planning. If there is no audit planning, will not be able to complete audit within time, within cost, or might be we will stuck during the audit. And if we stuck during the audit, might be we are affecting the quality of the audit as well. To perform audit efficiently, effectively, there must be audit planning before starting the audit work. What we need to do in audit planning, we need to prepare audit strategy. There are two main activities of audit planning: preparing audit strategy, and we need to define audit plan. Audit plan is also called audit program. So before starting the audit work, there must be audit planning, we must define audit strategy and prepare audit plan. Audit strategy, what does mean by audit strategy? Audit strategy means to highlight risky areas. Strategy means to highlight risky areas and direct the work of audit team. To highlight risky areas and direct the work of audit team mean through audit strategy will be able to highlight risky areas. What is audit plan? Audit plan means detailed procedure plan about how to conduct audit. Detailed procedure plan about how to conduct audit mean what procedure audit team will perform, that we will state where in audit plan. Strategy will help us to highlight risky areas, and based on that risky area, we'll be able to define audit plan. How we can highlight risky areas in audit strategy? We can highlight risky areas through understanding the entity, and its environment. We can highlight risky areas through analytical procedures. We can highlight risky areas through risk assessment. We can highlight risky areas through determination of framework. In how we can highlight risky areas, we can highlight risky areas through understanding the entity and its environment, through analytical procedures, through risk assessment, through determination of framework. And whatever the risky area we have highlighted through audit strategy, accordingly, we need to define audit plan, audit program. Mean the plan we will assign to audit team, we will hand over to audit team. Accordingly, they need to conduct the audit. What is included in plan? In plan, we will include the identification of critical areas. Critical areas mean the list of high risky areas that we have found through audit strategy. We will define preliminary materiality levels. We will define nature, timing, and extent of audit procedures. And this complete plan we will brief to audit team. So as per ISA 300, there must be audit planning before starting the audit work. Mean we should highlight risky areas and direct the work of audit team, so that audit team will work according to that direction. They will be able to complete audit within time, within cost, and effectively. And there are two main activities of audit planning: preparing audit strategy and defining audit plan. Audit strategy mean to highlight risky areas and direct the work of audit team. To highlight risky areas and direct the work of audit team. Audit plans mean detailed procedure plan about how to conduct the audit. To highlight risky areas, what we need to do, we need to understand the entity and its environment. Understanding the entity and its environment. Understanding the entity and environment, we should take knowledge. Understanding the entity and environment means we should obtain a knowledge about nature of company. The business, the company that we are going to audit, we should obtain a knowledge about the nature of the company, because through nature of the company, we can highlight risky areas. If the nature of the company is manufacturing a company or trading company, in manufacturing or trading company, inventory is always a significant account balance. This means inventory could be high risky area that we need to verify in more detail. If the nature of the company is a service oriented, then inventory will not be high risky area. Income and expenses could be high risky area. Mean the nature of the company, knowledge about nature of the company will help us to highlight high risky areas. Nature of the company have invested huge money into the property. So if there is any change in market value of the property, so there are chances of recording impairment. And if company haven't recorded impairment, asset could be overstated. This means asset, property asset is what high risky area. Nature of the company have invested into financial instruments. And if suppose company is not recording fluctuation, mean fair value change according to accounting standards, so these financial instruments mean financial asset could be misstated. So these are what a high risky area. Mean through nature of the company will be able to highlight risky areas. Understanding the entity and its environment mean we should obtain a knowledge about internal control system of the company to see whether it is a strong or weak. If client control system is strong, this means there are lesser chances of fraud and errors. If client system control system is weak, there are more chances of fraud and errors. Not even the bigger, even the small amount could also be misstated. Mean we can highlight high risky areas. Understanding the entity and its environment mean we should obtain a knowledge about the industry in which company is operating, as well as law regulation relating to that industry. If company is operating in an industry, that industry is volatile, there is downturn in the industry. This means company might not achieving its result properly. So there are chances company manipulating, mean overstating the sales, understating the expenses to highlight profit to keep the investor happy. This means expenses income could be high risk area. We should obtain knowledge about the environment, mean industry, market, the law, regulation that are required to comply with while operating in that industry. And if companies are not complying with law regulation, there could be chances of misstatement in provisions, liabilities. So we can highlight high risk area through understanding the entity and its environment, mean by obtaining a knowledge about the nature of the company, about internal control system of the company, about industry law and regulation, and taking knowledge about management methods used to measure its performance. In how management performance can be measured. I mean, what are the targets on which management can show performance and obtain bonus? Whether those are sale growth target, profitability target, or could be a company financial position target, gearing target. So based on that, we can understand where management can make misstatement, mean we will be able to highlight high risk areas. So audit strategy mean to highlight high risky areas so that we can direct the work of audit team, how we can highlight high risky areas through understanding the entity and its environment. We can highlight high risky areas through analytical procedure as well. Through analytical procedures as well. What is analytical procedure? Analytical procedure mean comparing current year data with the previous year data. I mean current year financial statements with the previous year financial statements. And there is a auditing standard on analytical procedure ISA 520 that we need to cover. If we compare current year financial statements with the previous year financial statements, we can highlight high risky areas. How? Suppose we have compared current year sale with the previous year sale, and we identified the sale in current year has been increased as compared to previous year by 15%. By 15%. Up to 10% increase in sale is normal. This is due to price inflation that happen every year. If company sale have increased more than 10%, this means volume of sale has increased. Mean company have sold more goods as compared to previous year. And if this increase is justifiable, like company have sold more units as compared to previous year, then this 15% increase is fine. Otherwise, sale could be overstated. So we identified sale has been increased by 15% as compared to previous year. So we asked the marketing department whether we attracted more customer this year. And we check the compactor financial statements whether their sale has also been increased by this percentage, mean due to growth in the industry. But if we check compactor financial statements, their sale remains same, mean increased by 10% rather than 15%. This means there is no growth in the industry. So if marketing department is saying, no, we were doing the same level of marketing as per previous year, there was no change in marketing. So this means this sale could be overstated. We will highlight this as a high risk area. Will not say this is misstated. It could be misstated because we are at planning stage. We are highlighting high risk area that we will audit in more detail during the audit. Through analytical procedure, we compare total assets with the previous year total assets in balance sheet. And we realize there is an increase in total asset. And if we check, there is increase in non-current assets, like company have bought new asset during the year. So if there is increase in assets, there must be increase in depreciation expense as well. If we compare the depreciation expense current with previous year, we realize depreciation expense has been decreased as compared to previous year. Well, in fact, they must be increased because company have bought new asset. This means there are chances either asset could be overstated or expenses could be understated to highlight the profits. So we will highlight these risky areas. We compared the liabilities in financial statements and we saw the non-current liabilities have increased as compared to previous year. This means if non-current liabilities have been increased, there will be increase in interest expense, finance cost as well. While comparing finance cost, we identified the finance cost is the same as the previous year. This means there are chances company is understating the expense. So we will highlight this high risky area mean through comparison of current year financial statements with previous year financial statements in analytical procedure, will be able to highlight high risky areas. We can highlight high risky areas through risk assessment. Risk assessment means through identifying and analyzing audit risk and its components and how we can highlight high risk areas using audit risk, that we will discuss later on in today's lecture. And there is a standard on this ISA 315. We can highlight high risk areas through determination of framework. Determine means taking knowledge about a framework. Framework means accounting standards that are applicable for the company. If company need to comply this standards, will be able to highlight high risky areas if company is not accounting as per that those standards. Suppose company have invested into the financial instruments, this means company need to comply with IFRS 9. So according to knowledge of IFRS 9, we can highlight high risky areas mean where company can make misstatement in the financial statement. If company is operating in different segments, this means per IFRS 8 segmental reporting company need to comply. And if company is not complying with segmental reporting, there could be misstatement where we're gonna discuss later on. Mean by taking knowledge about the accounting standard required for the company or law and regulation required for the company, will be able to highlight high risky areas. Mean through these understanding the entrance environment, analytical procedures, risk assessment, and determination of framework, will be able to highlight high risky areas. And whatever the high risk areas we have identified from audit strategy, accordingly, we will prepare audit plan. Audit plan means direction of the audit team work. What is included in audit plan? In audit plan, we will put a list of critical mean high risky areas for the auditing, so that they must be aware what are the areas where they need to perform detailed procedures, what are the risky areas. We will define preliminary materiality levels. Preliminary materiality levels mean we will calculate 5% of profit and will set aside a figure. We will calculate 1% of revenue and will define an amount. We will calculate 1% of total assets and will define an amount, and these amount we will give to the audit team. So that during audit, if they are finding any misstatement, they must compare with these amounts. If the misstatement is above these amounts, they should consider it material. If the misstatement is below these amounts, they should consider immaterial. Why we have defined these amounts? So that they should not be calculating percentage during the audit. So this is what preliminary materiality level, or we call it materiality of a whole financial statements that we define at the planning stage. And then the main part of audit plan is what defining in nature, timing, and extent of audit procedures. Mean whatever the account balances in the financial statements, on which account balance we should perform test of control, where we should perform substantive procedure, we will define here. Obviously, high risky area, we need to check in more detail. We need to perform substantive procedure. On low risky area, we can verify through test of control. We will define the timing of the audit. Timing of the audit means which area should be audited when. What are the areas in financial statement that should be audited during interim audit? Like income statement item, normally we verify during interim audit. What are the areas that we should audit in final audit? Balance sheet item we normally verify it during final audit. And what are the areas that we should audit at the final day of the year end, like inventory, cash at bank that we must verify at the final day of the year end. So we'll define a timing of audit procedure leading to each accounting area. And we will define the extent. Extent means sample size, where we should test more transaction. Obviously, high risky areas, we should test more transaction, means sample size will be large. And for low risky area, we should perform less procedures, means sample size will be small. And all this list of critical areas, materiality levels, and the nature, timing, extent of audit procedure, we will brief to the audit team, so that audit team will work according to this plan, and they'll be able to complete audit within time, within cost, and on quality basis. This nature, timing, extent of audit procedure is also called response to risk. In the risky areas that we have identified, what should be our response, mean how much transaction we should test, when we should test, and how we should test, either test of control, either substantive procedure, and there is a standard ISA 330 response to risk. So as per ISA 300, auditor must perform audit planning before starting the audit work. Audit planning means he should highlight the risky areas and direct the work of audit team. How we can highlight risky areas? Through audit strategy, mean understanding the entry environment, analytical procedures, risk assessment, determination and framework. And what is audit plan? Detailed procedure plan about how to conduct the audit, and it includes identification, mean list of critical high risk areas, defining preliminary materiality levels, defining nature, timing, extent of audit procedure, and brief the plan to audit team. Now let's discuss what is the difference between audit strategy and audit plan. Audit strategy means to highlight high risky areas and direct the work of audit team. Audit plan means detailed procedure plan about how to conduct the audit. Audit strategy is prepared before plan. Plan can be defined after the strategy. Because first we will highlight high risk areas and then we'll be able to define audit plans. So audit strategy is prepared before plan and plan can be defined after strategy. Audit plan is more detailed as compared to audit strategy. Why it is more detailed? In audit strategy, there is only high risky areas. While in audit plan, along with the high risky areas, we have defined response to risk as well. So that's why audit plan is more detailed as compared to audit strategy. Audit strategy define scope, timing, and direction of audit. Audit strategy defines scope, timing, and direction of audit, overall audit, while plan define nature, timing, and extent of audit procedures rather than audit. What is meant by scope, timing, and direction of audit? Based on the highlighted risky areas, we will be able to define scope of our audit. Scope of audit mean whether the audit will be high risky or low risky. If we have found more risky areas, the audit will be high risky. This means we need to assign a highly experienced staff to this audit. If you have found low high risky areas, this means scope of audit is low risky, so we can assign even less experienced staff to this audit. Timing will be able to define whether we will need to put more time in auditing this client or less time. If more high risky area, it will require more time during the audit. Mean there could be delays during the audit. If less high risk area we have identified, this means we'll be able to complete audit quickly. Direction of the audit mean we will be able to identify how much staff we should direct to this audit, what kind of skills and knowledge experience are required for this audit, either high skill experience or lower or medium skills. Mean through audit strategy, we'll be able to define scope, timing, and direction of complete audit. While through audit plan, we'll be able to define nature, timing, and extent of audit procedures. So before starting the audit work, we must perform audit planning. We must prepare audit strategy and define audit plan. Audit strategy means to highlight risky areas and direct the work of audit team. How we can highlight high risky areas through understanding the anti-ants environment that we have covered. Now we need to cover these two topics in detail: analytical procedures and risk assessment. This materiality we have already discussed in reporting topic. I mean, these four topics we need to discuss in detail. So let's move towards analytical procedures. Auditing standard ISA 520. Analytical procedure mean to compare financial data with financial data, financial data with non-financial data, and ratio analysis. That is also called plausible relationship. So analytical procedure means to compare financial data with financial data with non-financial data, and ratio analysis. Why? To investigate unexpected fluctuations which could have resulted from misstatement. So analytical procedure means to compare financial data with financial data with non-financial data, and ratio analysis to investigate unexpected fluctuations which could have resulted from misstatement. Financial data with the financial data comparison means comparing current year financial statements with the previous year financial statement. And while comparing, if we have identified any unexpected change, that will be called unexpected fluctuation. So we need to investigate. We need to ask the reason behind this change from where company staff. If that reason is justifiable, that's fine. If that reason is not justifiable, so we will say this change is resulted from misstatement. I mean, this is high risky area that we need to verify in more detail during the audit. And comparison of financial data with financial data mean comparing current year financial statements with the previous year financial statements, with the budgets of the company, and with the competitors' financial statement. Comparing current year financial statements with the previous year financial statements, with the budgets of the company, and with competitors' financial statement. This is what financial with financial data comparison. Not only we need to compare financial data with financial data, we need to compare financial data with the non-financial data as well. What is financial data with non-financial data? Comparing current year financial statements with the department statistics or summaries. Comparing financial statements with department statistics or summaries. Departmental reports are called non-financial data. How we will compare this? Suppose current year financial statements, we compare with the previous year. What we compare? We compare the wages figure. In previous year, the wages was 600. In current year, the wages is a similar 600. This means there is no change, there is no unexpected fluctuation. But while comparing wages, if we realize in previous year wages was 600, while in current year wages are coming at 700. So there is fluctuation about 100. Is that? So what we need to do, we need to investigate the reason behind this. We discussed with the wages department, or we check the wages department reports to identify the reason, and we asked whether there is an increase in number of employees as compared to previous year. They said yes, we appointed new employees. Okay, the change could be due to new employees. Or the other reason could be, is there any increase in wage rate as compared to previous year? The departmental report saying yes, there is increase in wage rate as well. Okay, how much was the change in wage rate? They said we changed the wage rate by 10%. This means 10% of 600 will become 60. So this must be 660. While current year wage is showing 700, still there is a 40 difference. We ask, can you calculate what's the wages of our new employees? Yes, we can calculate, and that is what, say 40. So becoming what, 700. This means there is no unexpected fluctuation. There is no chance of misstatement. But while calculating, if we calculate the new employer wages are 140 rather than 40. This means wages for the current year should be 800, while financial statement showing 700. This means these look like understated by 100, so we'll highlight this risky area. This is what comparing financial data with the non-financial data mean department summaries statistics. And in analytical procedure, not only we compare current year financial with other financial statements with departments reports, we also perform ratio analysis because there are some account balances. While comparing the amount, we cannot identify the reason behind the change. Like debtor amount, while comparing current with the previous, we cannot find the reason behind the change. We need to calculate debtor days of current year and compare with the previous year. GP figure, while comparing only the gross profit figure currently the previous year, we cannot identify the reason behind the change. We need to calculate the GP margin and compare with the previous year. Then we'll be able to highlight why there is a difference. Net profit figure, no, net profit margin we need to calculate, and then we'll be able to realize why there is a change. Mean we perform ratio analysis as. So in analytical procedure, there are three techniques used. There are three types of analytical procedure. What? Comparison of financial data with the financial data, comparison of financial data with the non-financial data, and ratio analysis mean plausible relationship. We perform analytical procedure at three different stages or level of the audit. So we perform analytical procedure on three different stages or levels of audit. We perform analytical procedure at planning stage. We perform analytical procedure during the audit. And we perform analytical procedure at a final review stage. During audit, we perform analytical procedure in comparison of financial with financial, financial with non-financial, ratio analysis at three different stages of the audit. Mean complete audit process. We perform analytical procedure three times, three different levels. At planning stage, we perform analytical procedure, and it is compulsory, mandatory. We must perform analytical procedure at planning stage. Why? To highlight high risky areas as per ISA 300 audit planning. It is a compulsory procedure that we need to perform to highlight high risky areas. We cannot skip this at planning stage. ISA 300 require, we must perform, mandatory. We perform analytical procedure at a final review stage. And here, these are also mandatory. What is final review stage? Before signing the audit report, engagement partner review the work of audit team by reviewing the working paper, that is called hot review. How he review the working paper? He see the financial statements. Financial statements are normally prepared comparative. Along with current year, previous year figures are also stated. What he does while reviewing the working paper of the audit team before signing the audit report, he compare each figure in the financial statements and see if there is any significant change. He will see in the working paper whether we have obtained evidence for this change or not. If there is significant change in any of the figure, he will see in working paper whether we have obtained evidence for this change or not. Mean to see whether more work is required or not. To see whether all evidence has been obtained or not, and this is mandatory to perform analytic procedure at the final review stage as well. At planning stage, to highlight high risk areas, part of audit planning. And final review stage, before signing the audit report, to ensure whether all evidence has been obtained, whether more work is required or not. Analytical procedures are also performed during audit as well. And performing during audit is not mandatory, it is optional. It's on company management. If they need to perform, they should, otherwise they can ignore. Where during audit and procedures are performed before substantive procedure. What is meant by substantive procedure? What is meant by substantive procedure? Detail work. So before checking any of the account balance through substantive procedure mean performing detail work, what auditor does before moving towards detail work, they perform analytical procedure mean they compare current year figure with the previous year and see if there is any change and that change is justifiable. Like here we justified 700 is equal to 700. This means there is no need to perform substantive procedure. We can include previous year working paper into current year as well. If we were the auditor in previous year and previous year, we have verified this account balance accurately. If the change is not justifiable, like as per the justification, the wages should have been 800 while in financial statement is showing 700. Now we should move towards detailed procedure means substantive procedure. So during audit, auditor perform analytic procedure before substantive procedure. Mean compare figure and identify the reason behind the change. If he is satisfied with the reason, this means there is no need to perform substantive procedure. Through this, we can eliminate or reduce substantive procedure. The purpose to perform here is to eliminate or reduce substantive procedure. So analytical procedures are performed at planning stage to highlight high risk areas, and they are mandatory part of audit planning. Per ISA 700 we must perform. 300 audit planning we must perform. And at final review stage, mandatory before signing the audit report to see whether more evidence is required or not, to see whether more work is required or not. And during audit, they are performed before substantive procedure. The purpose to reduce or eliminate substantive procedure. If we are performing analytic procedure at planning stage, its name will be analytical procedure. Same work we need to perform comparison of financial with financial, financial with non-financial, and ratio analysis. If we are performing at final review stage, the name will be analytical procedure. But if we are performing during audit before substantive procedure, its name will change to substantive analytical procedure. What is substantive analytical procedure? The same comparison of financial with financial, financial with non-financial, and ratio analysis to investigate unexpected fluctuation, which could have resulted from misstatement. But as we are performing before substantive procedure, so its name will change to substantive analytical procedure. What is the purpose? To reduce or eliminate substantive procedure. Are you with me? So what is analytical procedure? What are the techniques used in analytical procedure? And we have discussed 3 stages or level where we perform analytical procedure. There are some inherent limitations in performing analytical procedure, especially at the planning stage. There are some inherent limitations in performing analytical procedure, especially at the planning stage. What are the inherent limitations? Normally, if suppose year end is 31st December and we are doing planning in say October, this means in ADAC procedure we need to compare current year financial statements with the previous year financial statements. Can we get current year financial statements before year end? No. So how we can perform comparison of current year with previous year? We will be having a draft financial statement. And if there is a too much change in draft and actual results of the financial statements, it could affect our planning. This is one limitation. Mean if you at planning stage, might be we don't have the actual data because we are performing planning before year end. So we'll be having draft data and actual data. If there are too much changes, too much differences, so our planning could be affected. Who is providing draft data? Company management. So there could be deliberate manipulation from the management in draft data as well. The data provided by management could be manipulated. And if there is manipulation in the data, ultimately it could affect our audit planning. Sometimes company's system is not designed in a way like we can get data before year end, because company do not record on regular basis transaction, they record on interval basis, and system is not designed we can get data before year end. Mean issues in obtaining data before year end, so ultimately will not be able to perform our planning based on analytical procedure if data is not available. So these are inherent limitations associated with performing analytical procedure at planning stage. I mean, data is draft, and due to difference between actual and draft data, planning could be disturbed. And if the draft data is provided by company management is deliberately manipulated, ultimately it could affect our planning. And sometimes due to issues of internal control system, like is not designed to get data before year end during the year, so there could be issues in planning. So this accounting auditing standard ISA 520 we have completed. What are the different types of analytical procedure? At what stages levels analytical procedure are used, and what are the inherent limitations associated with analytical procedures? So at planning stage, we should prepare audit strategy, mean highlight risky areas and define audit plan. How we can highlight risky areas? Through understanding the entity and risk environment, through analytical procedures, through risk assessment, and through determination of framework. So understanding the environment mean obtaining knowledge about nature of the company, about internal control system, about industry, law, regulation required for the company, and management methods used to measure its performance, because through this knowledge we'll be able to highlight risky areas. We should perform analytical procedures to highlight high risky areas, and we should perform risk assessment to highlight high risky areas. And this is the main topic that we need to cover, because our question number one in the exam paper is based on risk assessment, mean audit risk. Examiner provide a scenario and asks us to identify and evaluate audit risk. So let's move towards this risk assessment. There is the auditing standard ISA 315. The name of ISA 315 is identifying and assessing the risk of material misstatement. Identifying and assessing the risk of material misstatement through understanding the entity and its environment. And this is the small name of ISA 315, identifying and assessing the risk of material misstatement through understanding the entity and its environment. We at planning stage, we must identify and assess the risk of material misstatement. How? By obtaining knowledge about the company and its environment, mean understanding the entity and its environment. In simple words, we should identify and assess audit risk and its components. Simple word, we should identify and assess audit risk and its components. There are three components of audit risk: inherent risk, control risk, and detection risk. Inherent risk, control risk, and detection risk. What is audit risk? What is meant by audit risk? Anybody, what is audit risk? Are you guys there? Rita, are you there? Ragi, are you there?
Yes, sir.
What is audit risk? Mr. Mukhendra, what is audit risk? Audit risk, a risk of giving inappropriate opinion. A risk of giving inappropriate opinion due to undetected mistakes. In risk of giving a wrong opinion is called audit risk. If during audit we haven't detected the misstatements and we provided unqualified opinion, and afterward our work proved negligent, mean our opinion was wrong. So that is what audit risk mean. We'll be facing what claim damages from the investors. So audit risk is what? A risk of giving inappropriate opinion due to undetected misstatements. And at the planning stage, we should identify and analyze this audit risk. We should see whether the audit risk in this client, mean risk of giving wrong opinion, is a high or low. If there are more chances of fraud and errors, we have found too many misstatements, high risky area, this means audit risk is high. And accordingly, we should adopt audit plan, mean we should assign more experienced staff, we should move towards substantive approach. But if at the planning stage, we identified client internal control system is strong, there are less chances of fraud and errors, and we have identified very few high risky areas, this means audit risk is low. There is a low chance of giving wrong opinion. This means we can assign even a less experienced staff to this audit. Because through assessment of this audit risk, we'll be able to define our audit plan. But we should identify and assess the three components of audit risk. And audit risk is equal to inherent risk multiplied by control risk multiplied by detection risk. And this is called audit risk model. And audit risk is a combination of three components: inherent risk, control risk, and detection risk. What is inherent risk? A risk due to nature of company. Or we can say what is inherent risk? A risk that misstatement may occur in financial statement. Meanwhile, obtaining knowledge about the business, about the nature of the company, if there is any chance of misstatement, we will call it inherent risk. And obtaining knowledge about the business, about the nature of the company, if there is any chance of misstatement, we will call it inherent risk. Company is a manufacturing company, so there is a chance inventory could be overstated. This is what inherent risk. Companies operating in fashionable products or technological products. Companies operating in fashionable or technological products. If companies operating in fashionable technological products, there is a chance inventory could be overstated because these technological products become obsolete quickly. These fashionable products become out of fashion quickly. And per IAS2, we should record inventory at lower of cost and NRV. So there could be chances if company haven't adjusted the inventory to NRV because their NRV of obsolete product out of fashion products will be lower than cost. So chances that inventory could be overstated, expenses understated, and profit overstated. This is what nature of company. Companies operating in technological products, fashionable products, books, CDs, DVDs. So there is always chance of overstatement of inventory. Nature of company, saying company is newly formed. Newly formed means company just established 15 months back. And there is a research on newly formed companies. More than 70% companies failed in their first 2 to 3 years. They collapsed within 2 to 3 years of their beginning. Why? Because at start, you are having a funds, and through those funds, you can survive maximum 2 to 3 years. And if your products are not becoming successful, you're not generating revenue, there could be cash flow going concern issues in the company. And there is accounting standard on cash flow going concern. IAS 1 says if there are cash flow issues, we need to disclose. So if company is newly formed, so chances that there could be cash flow issues which may not be disclosed properly in the financial statements. This is what inherent risk due to nature of company because it is newly formed. So due to nature of company, if we are aware about any chance of misstatement, or by obtaining a knowledge about the company, if we are aware about any chance of misstatement, this will be called inherent risk. Company is a self-constructing its asset by using a loan. If company has obtained a loan to construct any asset, per IAS 16, cost incurred from start of construction date until completion date should be capitalized, including borrowing cost. After completion date, cost should be expensed out. And chances if company has capitalized after completion date cost, asset could be overstated, expenses understated. This is what inherent risk. Company has invested into the property and there is a slump in the property market. There is a slump in the market. Ultimately, there is a need for impairment of assets. And if a company is not recording impairment on assets, so asset profit could be overstated and expenses understated, we will call it inherent risk. Mean, while obtaining information about the company, if we are aware about any chance of misstatement, we will call it inherent risk. Whenever we are discussing inherent risk, we need to state what misstatement is going to be happen in the financial statement. Mean we should always mention the type of misstatement that is going to be happen in the financial statement. And what words, what terms comes under misstatement. Chance of error is also misstatement. Omission of figures is also misstatement. Misclassification means misstatement. Understatement, overstatement, undervaluation, overvaluation, mean misstatement, non-disclosure, mean cash flow issue is not disclosed properly, misstatement, manipulation, mean these words we can use while discussing inherent risk, because these words mean misstatement. If we are not using these words, we are just explaining the issues due to technological products. Inventory could become obsolete. This is inherent risk. No, due to technological products, inventory become obsolete. And if company not recording inventory per IAS 2, chances that inventory could be overvalued. This will be called inherent risk. Meanwhile, discussing inherent risk, we need to explain what kind of a chance of misstatement in the financial statements. Either there is chance of error, there is chance of omission, misclassification, under overvaluation, non-disclosure, or manipulation. If you are not using any of the word, ultimately examiner will not give any marks. We should not only discuss the issues, we should discuss the issue and the chance of misstatement that is going to be happen in the financial statements, meaning effect on financial statements we should explain. If you are not affecting effect on financial statements, in what could be the chance of misstatement, there will be no marks. Technical area. So inherent risk, a risk due to nature of the company. Company is dealing with fashionable products, technological products, books, CDs, DVDs. So these products become obsolete or out of fashion quickly. And if company not recording inventory per IES to lower of cost and NRV, chances that inventory could be overstated inherent risk. Company have invested in property and there is a slump in property. So if company is not recording impairment of asset, chances that asset profit could be overstated and expenses understated. This will be inherent risk. If company is newly formed, so chances that a company may be facing cash flow issues. And if those issues are not disclosed properly per IES 1, financial statement could be misstated. This is inherent risk. Company is a self-constructing its asset. And if due to non-compliance with IES 16, after completion date, costs are also capitalized, chances that asset profit could be overstated, expenses understated. This is inherent risk. If company has provided warranty to its customers, for IAS 37, there could be warranty provision in the financial statements. If the provision is omitted from the financial statement could be misstated. This is inherent risk. Company accountant is unqualified. If accountant is unqualified due to lack of knowledge of accounting standard, chances of errors in financial statement, this will be called inherent risk. Company has obtained asset on leases. If company has obtained asset on leases, so at year end, the current liability and non-current liability should be separately classified. And if company is not properly classifying current and non-current liability, financial statement could be misstated inherent risk. While obtaining knowledge of the company, if we are aware about any chance of misstatement, that we will discuss where in inherent risk. If we need to discuss the accounting standard, we need to discuss. If we are not discussing accounting standard, obviously we will not be able to gain complete marks. mean, this is an area where accounting standard application is required, where accounting standard knowledge is required. Company management. Remuneration include bonus on profit targets. So there are chances if management is not beating the required targets, so financial statement could be manipulated. This is what inherent risk. And whenever we are discussing inherent risk, we should mention the type of misstatement that is going to be happen. Could be. We will use the word could be. We will not say assets are overstated, inventory are overstated. No, this will be able to say based on evidence. At planning stage, we don't have evidence. We are highlighting this area, so could be overstated, could be understated, could be manipulated. I What is control risk? A risk that control system of client company may not prevent, detect, and correct a mistake. Mean all the control issues of client company we will discuss where under control risk. Company do not have internal auditor. So in absence of internal auditor due to lack of monitoring of the control, misstatements may not be prevented, detected, corrected by the system. This is what control risk. Company have installed a new accounting IT system. Whenever a company is installing any new system, there are always early stage problems in the system. Mean there could be some kind of bugs. There could be staff is not trained to use the system. So always there are issues. And due to that early stage issues, misstatements may not be prevented, detected, corrected by the system is called control risk. If company management attitude regarding controls, the term used control environment is poor. So due to poor control environment, if employees are also not following the policies, so misstatement may not be prevented, detected, corrected by the system. We'll discuss where under control risk. So no internal auditor due to lack of monitoring of control, misstatement may not be prevented, detected, corrected by the system. System is newly installed or outdated. So if policies are not properly followed, misstatements may not be prevented, detected, corrected by the system. If poor control environment, so due to not complying with the policies, misstatements may not be prevented, detected, corrected by the system. Company accountant is unqualified. This we can discuss in inherent risk as well. There are chances of errors due to lack of knowledge. This we can discuss in control risk as well. If accountant is unqualified, so due to lack of knowledge about the system, misstatements may not be prevented, detected, corrected by the system. Mean the control issues of the client company we will discuss where under control risk and normally hardly 1 to 2 control risk we can find in one scenario. Inherent risk we can find so many. What is detection risk? It's due to auditor. A risk that auditor may not detect mistakes. Inherent control risk, these are risks relating to company, client company. They are not under auditor control. But detection risk is under auditor control, a risk that auditor may not detect misstatements. Why? Auditor is new. We are going to conduct the audit of this kind of company first time. So due to lack of detailed knowledge about client business, auditor may not detect misstatements. So we'll discuss where under detection risk. There is any limitation imposed on auditor. limitation, like time limitation imposed on auditor, like you need to conduct audit within 2 months. So due to that time pressure, auditor may not be able to detect the misstatements. We'll discuss where detection risk. We are going to conduct audit of a group company, and subsidiaries or some branches of the companies are overseas. And if due to shortage or lack of staff will not visit those branches or subsidiaries, auditor may not detect the misstatement. This is what detection risk. It could be relating to previous auditor resigned due to certain issues with the client management. And if those issues arise with us as well, it could affect our audit work and auditor may not be able to detect misstatements. We'll discuss where in detection risk. And this is relating to auditor. Auditor is new due to lack of detailed knowledge about client business. Auditor may not detect misstatement. Any limitation like time limitations due to shortage of staff, time, auditor will not be able to detect misstatement. And the reason for leaving the audit associated with previous auditor could affect our audit work in future, and auditor will not be able to detect misstatement. So inherent risk, any chance of misstatement, we will discuss under inherent risk. Control risk, control issues. And detection risk due to auditor new limitations or previous auditor may not detect a misstatement, that is detection risk. So there are three components of audit risk: inherent risk, control risk, detection risk. According to this standard ISA 315, there are two components of audit risk. One is called risk of material misstatement and other is what? Detection risk. Risk of material misstatement include inherent as well as control. So we can say audit risk is a model of risk of material misstatement multiplied by detection risk. If we are saying there are three components of audit risk, what are those? Inherent, control, and detection. We will not use the word risk of material misstatement. If you are saying there are two components of audit risk, what are those? Risk of material misstatement and detection risk. What's in by risk of material misstatement? Risk relating to chance of misstatement as well as control weaknesses. Are you with me? Sometimes examiner asks identify risk of material misstatement. This means we should discuss only inherent and control, ignore the detection risk, even if they are there in the question. If the requirement is to identify audit risk, then we will discuss all three: inherent, control, detection. How? We will practice a question. Are you with me? So detection risk is due to auditor, a risk that auditor may not detect misstatement due to sampling risk and non-sampling risk. So detection risk arises due to sampling risk and non-sampling risk. What is sampling risk? Sampling risk, the sample chosen from the population is not proper representative of the population. And due to that, if auditor unable to identify misstatements, so that will be detection risk due to sampling risk. Mean we obtained the very small sample, and in that small sample, all the characteristics of population was not included, and we couldn't identify that account balance properly. Mean we couldn't detect the misstatement due to sampling risk. So this is called detection risk due to sampling risk. How we can reduce sampling risk? By adopting statistical sampling techniques. Or increasing sample size. Mean always choose appropriate sample, enough sample. Non-sampling risk is what? The sample is appropriate, or might be auditor performing 100% testing, but still he is unable to detect misstatement. Why? due to auditor incompetence. Due to auditor incompetence. Mean he is not performing procedure properly. He is performing wrong procedures. On high risky areas, he is performing test of control instead of substantive procedure. Or he has performed procedure properly, but he is analyzing results wrongly. Mean client was high risky. Irrespective of checking materiality of profit on 5%, he is checking materiality of profit on 10%. This is what non-sampling risk means. He is unable to detect misstatement due to auditor incompetence. How we can reduce non-sampling risk? Through training of the auditor, or recruiting the skilled auditor, mean assigning skilled auditor to the audit team. Or we should train the auditor so that if he is aware at what area, what kind of procedure should perform, what are the materiality level he should use, and what procedure he should perform, then we can eliminate this non-sampling risk. So we have covered ISA 315, identifying and assessing audit risk through understanding the entity environment. In at planning stage, we should identify and assess audit risk and its components. Risk of giving inappropriate opinion due to undetected misstatements. And there are three components of audit risk: inherent risk, control risk, and detection risk. Inherent risk, a risk due to nature of company, a risk that misstatement may occur. And when we are discussing inherent risk, we should state what kind of misstatement is going to happen in the financial statement. If we are saying companies operating in technological products and inventory could become obsolete, this is what business risk rather than inherent risk. Company is newly formed, so company is facing cash flow issues. This is what business risk rather than inherent risk. Company has invested into property and property market is in slump, so this is business risk rather than inherent risk. Inherent risk arises due to business risk, mean issues of the business. The chance of misstatement will be called inherent risk. Company has invested in property market in slump. So if impairment of a property is not recorded per IAS 36, chances that asset profit could be overstated, expenses understated. Now examiner will understand, yes, this is inherent risk, he will assign mark. Companies operating in technological products that become quickly obsolete. So chances that if inventory is not recorded as per IAS to lower of cost and RV, inventory profit could be overstated, expenses understated. This will be called inherent risk. I mean, the issues of the company are business risk. And due to that business risk, what is the chance of misstatement in the financial statements? That will be inherent risk. What is control risk? A risk due to control system. That this control system may not prevent detect misstatements. And detection risk, a risk that auditor may not detect misstatements due to sampling risk and non-sampling risk. Let's take a break. After break, we will discuss a good question on this risky area.